Hello everybody, this is Ghabour. I am CEO and co-founder of Key Advisors Wealth Management. Please follow us on Twitter at Common Sense Bull, as well as sign up for our YouTube channel and become a subscriber to get up-to-date info in regards to our viewpoints on where the markets are potentially heading. So I just finished a quick hit on Fox Business and talked about the reason why we have recently gone to one of our highest cash levels we've had all year long. We are not a buy and hold firm. We do like to be very active in the markets based on what we're seeing. There are some times that we feel like it's best to be fully diversified in a strategy where maybe buy and hold will work for a period of time. And then there's other times that we feel like there's very few places to hide and you need to be more concentrated in certain areas. And so we feel like this is one of those moments in time. And the reason why I shared with Fox Business that we believe we now have a higher likelihood or probability, I should say, of a credit event sometime in the next 6 months is because of the data that has changed. We are a data-driven firm. Now look, this is our opinion based on the data. Of course, we could be wrong, and don't make any changes on your portfolio just based on our opinion. Do your own due diligence and make your own decisions. But one of the two biggest things that have changed, in our opinion, in regards to where we were just a few months ago, as you look at the end of July, is interest rates, okay? We continue to pile on more and more debt as a country, and I believe that inflation is going to prove to be really sticky. And because of those two things, with a weak balance sheet and inflation sticky, I believe you're going to see interest rates go back to the highs that we've seen. And if you look in the summer, you know, we had a 10-year at 4% and below 4%. And now we just hit 5% recently. And I believe that rates are going to blow through that 5% number. When you just take a look and do the math, the cost of capital has increased a lot more than what even we had anticipated coming into this cycle 2 years ago. And just do the math as our team sits down and we calculate the amount of debt that companies have and families have that are not locked in. So you have floating rate debt and money that has to get refinanced. How is it mathematically possible for some of these families and businesses to carry a cost that's potentially double what it was just 6 months ago? So I don't think it matters what the Fed does. I believe the bond market is going to continue to put added pressure because think about it, at the end of the day, who would buy a U.S. government bond right now that's long-term, paying less than 5 or 5.5% when the balance sheet, in our opinion, is one of the worst we've had in modern history? So I believe investors are going to demand a higher yield to hold that paper because of the risks that we have. And so when we do the math on that, we believe that the probability of some type of credit event is much higher now than where it was 3 months ago. And that's why we have recently gone to a higher cash level. And I'll leave you with this on the credit event. In March, when the banks had that credit event, the 10-year was only at 4%. So if one of the reasons why these banks had that pressure on them was because the Treasury prices had dropped so much and they had problems with commercial loans and commercial paper on their balance sheet, well, things are worse now than where they were in March. And I think this is a big reason why when you look at the KRE, which is an index ETF of regional banks, it's lost over 1/3 of its value this year and nearly half of its value since the beginning of last year. So to us, this tells us that there is potentially more stress in some of the smaller banks, just like we had in March. So again, doesn't mean it's going to happen, and I hope it doesn't happen. But it's a big warning sign for us, and which is why we are being very cautious. And then lastly here, the other dynamic that has changed in a big way is the geopolitical issues. We pray that there is some peace overseas, but as we've seen the Middle East crisis actually get worse, we are worried about an escalation there. And then we're worried about other countries getting involved. And look, you can't put a probability on this because these are, I would refer to them as black swan events. But the other big elephant in the room is China. If China, in our opinion, is going to make a move, they would probably make that move within the next 6 months when we are at our weakest. And I say our weakest because if we are helping in 2 wars and we continue to accumulate a lot of debt, one could make the argument that we're spread too thin for the first time in a very long time. Again, this is just purely opinion from a geopolitical perspective, which is a much harder thing to try to predict than the data that's coming in on interest rates. But when you have those two dynamics potentially happening within the same time frame, for us, it is our time to be cautious because, again, our client base is different than many. If you're in your 20s or 30s and trying to accumulate wealth, maybe this is a buying opportunity to take on a lot of elevated risk. But this is why we believe a credit event has a much higher probability than where it did 3 months ago. And we're just going to sit back and wait and see how the chips fall in regards to this interest rate market. We need the bond market to stabilize before we will feel more comfortable about a credit risk coming off the table. So that's just our 2 cents in regards to our thoughts and why we discussed what we discussed this morning on Fox Business. I hope this brought value to you and your family, and I hope you make it a winning week.